Investor's Edge with Gary Kaltbaum. Straight talk about you and your money. Now from the BizTalk studios, here is Gary Kaltbaum.
And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. Today is Thursday, June 20th, 2024. We've got a great show for you tonight. As always, want to thank you very much for being here. Before we dive into the specifics today, we want to let you know just some housekeeping that this show is about you, your money, all of the fun and fine points in between, and sometimes not so fun depending on what the situation is. I try to take things in a fun way if at all possible. Just as a quick reminder, if you don't get this show in your city, you can go to GaryK.com, listen live or archive. I know I do speak fast. I try to slow it down, but there's just so much I want to say and so little time. So if you do miss anything, you can pause it, rewind it, fast forward it at your leisure 24/7, all for free on GaryK.com. That being said, also you can follow Gary on X, or formerly known as Twitter, by just pressing the button. There's a big button that says Gary K on follow Gary on X, right on GaryK.com. And then also you can subscribe to get Gary's morning notes sent directly to your inbox. You may email Gary, ask about his money management services. And if you'd like more from Gary, you can join convictionleaders.com, which is his premium service. Every day he shares updates with members. He gives daily webcasts. Every night after the close, he lets you see what he sees. He goes through charts. He goes through sectors. He goes through stocks. He goes through a lot of great stuff and a lot more. All of that available on convictionleaders.com. All right, let's talk about the markets. There's one word to describe the market right now, and that's extended. When I was on Tuesday, I said the market's extended, but I'm going to spend some time here and talk to you about this because it's really, 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 really important to understand that some of the logic behind the thought process here. First off, there's no rule that says an extended market can't get a lot more extended before it pulls back. But typically, there's certain norms that happen, ranges, not 100% to the penny, but again, it's more of an art than a science. And when the market gets, depending on the index you're looking at, the S&P 500, the NASDAQ 100, individual stocks, they get extended above the 50-day moving average by a certain amount. It gets into nosebleed territory. It gets into the area of, oh, wow, it's almost like screaming for a pullback. It increases, here's the magic word, the probability of a pullback. That doesn't mean you have to have a pullback. It just means the probability of a pullback increases several fold the further you get higher or lower you get away from the 50-day moving average. Think of the 50 almost as a magnet. So the NASDAQ 100, the QQQ, if you go there and look at the 50-day moving average, look at where we are today, it's somewhere around 7.5% above the 50. Well, the last few times, you might ask me, Adam, how do you know? How do you know if a stock is extended or the market's extended? And what is that magic number? Is it 7% above the 50? Is it 50%, 100%, 8%, 2%? Each stock, each ETF, each market, each index is different. And the way that you know is just by studying the way that instrument behaved in the past. That doesn't mean it's going to behave that way in the future. Past results are not indicative of future returns, so on and so forth. All it means is that it's a probability. So if you look at the NASDAQ 100, it's 7-8% thereabouts above the 50-day moving average. Okay, coming into it, we know the last several times the market pulled back, before it pulled back, whenever it got to 7, 8, 9, 10% above the 50, it typically, not always, but typically, maybe 11 at the most I've seen recently, but typically 7 or 8%, 9%, somewhere in that range for the QQQ, it's an area where, the market tends to pull back. Not always, but again, that's been the last several times. Now, if you go back the last 50 years or study the last 100 years, I'm sure there's mathematicians out there that can get more precise data, so on and so forth. I'm just looking at the last year and change. The last few big pullbacks we've had, right before them, pretty much, not everyone, the NASDAQ 100, the QQQ, was more than 5% above its 50. Simple. 7, 8, 9%, somewhere in that range. 6%, 5%. Sometimes it was even lower, 4%. But for the most part, it's get above 5, 6%. That's nosebleed territory. 7, 8, 9%, like where we are now, 8%. And you've had a big move up. So that's one thing to keep in mind. Now the S&P 500, a little bit different animal because it's not made up of the big growth tech stocks that are driving the market right now, mainly the AI stocks like the NVIDIAs of the world or the Microsoft, which I told you on Tuesday, NVIDIA overtook Microsoft to become the biggest company in the world. Microsofts of the world, the Apples of the world, which hit all-time highs, all these guys just about trading at all-time highs or near all-time highs, so on and so forth. The S&P 500 has some of those stocks, but it also has a lot of other areas. It's made up of 500 stocks, not 100. And the NASDAQ 100 are 100 high-octane stocks for the most part. Not all of them, but for the most part. So it tends to outperform over the longer period of time. Now, of course, it ebbs and flows. Sometimes the S&P outperforms, but the S&P doesn't move as much as the NASDAQ 100 does. So when the S&P 500 gets 4 or 5% above its 50, that's extended for that index. But 7, 8, 9, 10 for the NASDAQ 100 is extended for that index. So, and each individual stock might be different depending on how it's behaved with respect to its 50-day moving average going back in the last 12, 18, 24 months, 36 months, however you want to look at it. It's up to you. So, it's, again, extended doesn't mean you have to pull back. It just increases the odds that the market's going to pull back. And lo and behold, look what's happening. So, that's one. Two, I want to share another timeless concept with you. It's everything, all my work, I try to simplify it. They teach our kids, simplify your fractions, the lowest common denominator, right, in school. In my mind's eye, I want to simplify this as much as humanly possible. There's all these great quotes from people that are geniuses that say, simplicity is elegance. And, if you can't, basically, if you simplify things, you understand it. The simpler you go, the better it goes. Now, there's a big difference between simple and another S word, which means dumb. I'm not saying go stupid or go dumb. That's not anything at all. Simple is very, very powerful. Notice the difference here. Very powerful. So when you simplify things, it's easier for my brain to understand them. And then it's easier for me to articulate them and share them with other people, right? So let's talk about the levels of extension. Keep going there. So the 50-day moving average on the upside in bull markets, you get extended. How high does the stock or the market go above the 50? Like the semiconductors on Tuesday, we said the semiconductors are very extended, right? So I'll get to the next concept in a second. But in bear markets, the opposite is true. How far below the 50 does it go? And then typically before it snaps back into the 50. So the extension levels of extensions work on both ways, in bull markets and in bear markets. Now, the second point, or the next big thing I want to share, green light, red light. We all know if you drive a car anywhere in the world, for the most part, at least the Western world, you've got traffic lights and people respect the laws. And we've got red light, you've got a green light, and you got a yellow light. All right. In the market, it's kind of the same thing. Not 100% to the penny, but close. So there's only three ways, again, keep it simple, right, that the market can move after you buy a stock, or even the market can move, period. It can go up, it can go down, or it can go sideways. That's it. Doesn't matter what the stock is, doesn't matter if it's a currency, if it's a commodity, if it's real estate, you buy a house, you buy a building, you buy gold, you buy silver, you buy Apple, NVIDIA, Microsoft. It's all the same thing. If you're putting money at risk in anticipation for a reward and it's publicly traded and the prices aren't capped or fixed by some third party, but they're, it's a free market, it can only go up, down, or sideways. Well, okay. Each one of those represents a light in my mind's eye. A green light is an uptrend, yellow light is sideways, and a red light is downtrend. Really that simple. So understand that the market states change, which I spoke to you about last time briefly. And I discussed this in my book in Psychological Analysis, which was #1 on Amazon. Thank you everybody for all the great reviews and for buying it and all that fun stuff. It was #1 for 3 months. And in it, I outline all the stuff and then some. And there's some cartoons in there too. And I keep everything real simple. It's written in very easy to read language. And thank you, Sean, for that. And he's listening, he'll know. But the red light, green light, yellow light concept, the states are written in the book. So I talk about the states of the market change. And the same thing with stocks, and the same thing with currencies or commodities, or me and you and all of us, right? The day. Sometimes it's daytime, sometimes it's nighttime, sometimes it's raining, sometimes it's thunder, sometimes, the state, ice, snow, it changes. The state changes. Sometimes I'm tired, I'm awake, I'm excited, so on and so forth. So the market state changes well. Sometimes you're in an uptrend. After an uptrend, that's a green light is an uptrend, you're going to get one of two things. You're either going to get a yellow light where you go sideways, or you get a red light where you pull back. That's it. Nobody knows with 100% certainty when that uptrend is going to end, but the beauty is you don't have to know with 100% certainty. The markets, by definition, are uncertain. So the beauty is just to understand this is all about probabilities and then stacking the odds of success in your favor. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge.
Hi, I'm Gary Kaltbaum, host of the nationally syndicated radio show Investor's Edge. We're not just handsome radio people. We manage investors' money for a living, specializing in fee-based discretionary money management. No big commissions, just a fee on the assets that's managed. We also provide a full range of personalized services, including retirement planning, fixed income, and educational needs, all to assist you in achieving your financial goals. Understanding not all individuals have the same needs, we'll carefully evaluate your personal goals to determine a proper investment strategy. If your current approach to investing is not getting you to where you would like to be, call us to make an appointment for a complimentary portfolio review. The number to call is 888-422-5559. That's 888-422-5559. That's 888-422-5559. Investment advisory services offered through Kaltbaum Capital Management.
It's time to switch on the integrator units and get the brain cells working.
You're listening to
Hey, this promises to be fun.
Investor's Edge
The last bastion of quality programming.
with Gary Kaltbaum.
It doesn't get better than this.
And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. In case you're just joining us or missed any part of the show, you can go to GaryK.com, listen on any device you want for free, 24/7, which is absolutely fantastic. Thank you to modern technology. So I remember way back, 25 years ago or so, back in the late 90s, early 2000s, I was listening to Gary on AM radio. And if I missed it, I missed it. That was it. So let's I'm grateful for modern technology, let's put it that way. All right, speaking of technology, we've got technology stocks, semiconductor stocks extended, NASDAQ 100 stocks extended. A lot of the leaders that we've seen run recently are extended. So I spoke to you about the concept of probabilities and green light, red light, and knowing when a stock or a market's extended. Just look at your stock and look at the past year and a half and see on a percent basis, before they had pullbacks, how extended was the stock or the market or the index, whatever you're looking at, from its 50-day moving average. And then if you find patterns, which is all we're looking for is patterns, it's going to increase the probability. Oh, the last 4 or 5 times, the leading stocks or whatever, tech stocks or the NASDAQ or gold, whatever it was X percent above its 50, 3 out of the 4 times, or, whatever the case is, 7 out of 10 times or whatever the numbers are, most of the time, let's put it that way, it pulls back. Well, then now we're right at that level where most of the time it pulls back. Okay, noted. And then we're waiting for the pullback. So when the pullback comes, we shouldn't be surprised or caught off guard. And that's a big way, and I mean big way, for us to be able to have an edge. Talk about the investor's edge, right? So another way of having an edge is understanding that the market states change. So sometimes you're in a good run, the green light's on, and then after a big move up, like I mentioned earlier, there's only 2 ways you can consolidate that move. A, it goes sideways, or B, it goes down. And when you go sideways, which is the yellow light, it's more bullish of those 2 scenarios. But when you go down, there's a pullback, and pullbacks are normal and healthy in bull markets. Pullbacks are very healthy. Why? Because They shake out the late longs or the weaker hands, but also it gives the market a chance to pause and catch its breath before the next leg higher. So, next area, gold and silver. Look at the GLD or the SLV or gold and silver stocks, the GDX or GDXJ, the juniors or GDXJ, the gold GDX or the bigger miners, or anything you want that represents gold and silver. You had a big run up. You broke out of a beautiful cup and handle. If you have the ability to look at a gold and silver chart on a monthly basis, go back and look at it. It was one of the best symmetrical patterns I've ever seen anywhere, bar none. And I shared it with members on FindLeadingStocks.com for months before it broke out. And I just said, hey, I see this pattern. I'm going to point it out. Week in, week out, week in, week out. Nothing to do yet, but if and when it breaks out, I want to be on it like white on rice. And we were. And thankfully did very, very well as it broke out of that huge cup and handle pattern. Okay, you don't see that often, but when you do, it's important to pay attention. That was on the monthly chart of gold. You can just type in GLD and click on a monthly chart, and you can see it from earlier this year. It broke out, but go back the last 10, 15 years or so, 12 years, it was just massive, massive cup and handle. Anyway, finally breaks out earlier this year. We were ready. So that's important. They're not chasing and Monday morning quarterback when you do the work. And that's the next point I'll share too. It's the Ben Franklin's line about preparing to win. But before I get there, we were ready. So gold and silver had a huge move earlier this year. And then guess what? It got extended after the green light's over. Hey, time to pull back a little bit. And it pulled back. And it undercut the 50-day moving average just a little bit until a day like today where gold popped and it's trying to get back its mojo and resume its uptrend again. Now, depending on your time frame, depending on how you view markets, depending on how you manage risk, and depending on lots of other factors, things change and change quickly. But it's important to understand from a levels of extension standpoint, gold got extended back in late May, and it pulled back. It actually got even more extended back in late April, right? The end of April, in the middle of April, you were about 11% above the 50 in GLD, 9.5%, 10%, 11% above the 50. And then all of a sudden you pulled back. And then early May you bounced. You rallied back out, briefly made a new high. And at that point you were about 5.5% above the 50 because the 50 came up. And then you pulled back into early June. And now you're bouncing again and trying to get going and get its mojo back. All right. That's how these things work. Silver, a little bit different, but it got extended, and same thing in April. It was 15% above its 50-day moving average, and then it pulled back almost perfectly into the 50-day moving average in early May, bounced again into late May, where it was 18% above its 50. Now, silver tends to be a much more volatile index or creature or market. It's a market, so let's call it what it is. Where 18% above its 50 is not, it's almost unheard of, and something like the S&P 500 or the NASDAQ 100 even doesn't typically get that high. I can't even remember a time where it was that high. It might have happened before, I just can't remember it. But for silver, it just happened. And then it pulled into the 50. So green light, red light, green light, red light, get that concept? And then it bounced in the middle of June, right off the 50 in silver, and then today you're back above the 21-day, and you're breaking above a downward trend line. So silver, gold could be reemerging. Now, if you look at silver and gold stocks, the GDX and the GDXJ, that's again, those are ETFs that track gold and silver stocks. They're coming up the right side as well, trying to bounce. So it's almost like a game, a relay race, where you pass the baton from one person to another, where you have a situation here where tech stocks may be pausing now, or the market, U.S. stocks are pausing. Okay, fine. And then money's rotating into gold and silver. It could be happening. I'm not saying it is with 100% certainty. Nobody with 100% certainty, but there's a very big probability that's what's happening. So when you're in that situation where you have gold and silver emerging, and you have other indices that we know, stocks or S&P and NASDAQ, semiconductors, the SMH, so extended, all right, we want to note that, pay attention. And this is the next point, the probability and certainty. Nobody knows with 100% certainty, right? This is important. We're operating in a world that by definition is uncertain. The market is uncertain. Nobody knows with 100% certainty what's going to happen tomorrow, where the market's going to be in a year from now. But you can do it based on the probabilities, right? And then it all comes down to risk and reward. Again, risk and reward. People say, oh, get a lot of R&R, rest and relaxation. In my mind, it's risk and reward. So as long as you understand that component, when you're wrong, the risk small and the reward big, over time you'll do very well. Or at least fingers crossed, hopefully we will. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge.
You're listening to
America is talking.
Investor's Edge.
He's got to be pleased with that. The crowd is just on its feet here. He's a Cinderella boy.
With Gary Kaltbaum.
Comes highly recommended. You're going to feel better if you talk to him.
And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your leisure, as many times as you want, all for free on any device 24/7, all available on GaryK.com. If you want to join Gary's premium membership, I recommend people do that. I read it. It's great. It's available at convictionleaders.com. Now, that being said, a few things. We left off with risk and reward. Very, very important concepts, fundamental concepts. This whole show I'm talking about, there's only three things markets can do, go up, down, or sideways, or any investment for that matter. And I was interviewing somebody, gave me a great line once. He's like, we're not buying stocks. You're buying risk and you're buying reward. You're buying risk and selling risk. That's all it is. You're buying risk and the hopes for the reward. And I thought that was very, very interesting. So, Ben Franklin, next big life lesson that can be applied to, I'm all about timeless life lessons, as you can tell. Every once in a while I'll talk about specific stocks, but the brief times I'm on the show here, I really try to go as wide as I can, help as many people as I possibly can, and share some life lessons and timeless lessons with them, because these lessons have changed my life, have fundamentally changed my life. I was going to say fundamentally, technically, and psychologically changed my life, but it's not. Don't think that's a funny joke, so I'll just leave it. It's fundamentally changed my life. So, Ben Franklin's got a great line. Okay, he's on the $100 bill. We all know Ben Franklin, founding father, just next level, way ahead of his time, genius. Okay, great. He goes, basically, you either prepare to win or you don't. You prepare to lose. He goes, failing to prepare is preparing to fail. Failing to prepare, so if you don't prepare, what you're doing is you're preparing to fail. And it took me a few times to hear that. I heard it, but I didn't understand it until it came to investing and trading in stocks. I said, all right, how do I do this? At first, I was staring at the market and I was making emotional decisions. The whole point of my book is how people make rational, not emotional decisions, especially with their money, and making every mistake you can possibly think of, over trading, not having a plan. I was not preparing. I was always playing, catch up. This stock would break out. It would be extended. I'd have FOMO. I'd chase it. I'd buy it. I'd get stopped out on a normal pullback. And then it would add insult to injury. It would take off and go without me. And then the next thing happened again and again and again for years, until I said, okay, I've got to smarten up here. And then thankfully I did. And then over time I said, okay, I read a lot of books. And one of them, which Gary's mentioned, and actually I heard it on this radio show. It's unbelievable. 20 years ago, was Nicholas Darvis, How I Made $2 Million in the Market. And thank you, Gary. And by the way, everybody who's listening, please go on the podcast platform, follow the show, like it, subscribe, leave a nice review. It goes a long way, and it helps Gary. So, and it takes 2 seconds. Next, on any platform you're listening on, Spotify, on Apple Podcasts, wherever you're listening on, just like it, subscribe it, follow it, anything you want to do. Leave a nice review. That's great. And thank you for that. So Nicholas Darvis was a ballroom dancer back decades ago, 50s, 60s, time frame. And there was no internet. There were no cell phones. He'd have a telex or a fax machine. It was even, I think, before the fax. And the broker would send him barons and a bunch of stock charts about what happened in the week. He was a ballroom dancer, but he was in Asia, on the other side of the world. He'd be awake, the markets are sleeping, closed, and vice markets are open, he's sleeping. He can't call his broker and say, buy this, sell that. He had to telex or FedEx or whatever he was doing. There was no FedEx. I don't think there was FedEx back then, but he had to literally send his broker orders in advance, telling the broker when to get in, when to get out, basically putting stop orders in today's parlance. But he was flying blind. He couldn't even see what was happening until his broker got back to him. I think it was like a few days later, a week later, daily, whatever he was doing. It wasn't real time, is my point. And then they would adjust, and he keeps sending him the orders. By the way, he would make his decisions when the markets are closed. And when I read that book, I was like, oh my Lord. That was like the penny dropped, whatever, the moment the light bulb went off. I said, wow, I can do that too, because that allows me to plan ahead. And I started doing that. And then I developed a weekly process where I realized, oh, wow, that works well for me. And in my book, I talk about there's an infinite number of ways that people can make money in the market. Your job is to find one that works for you. So I always give the example of a personal trainer. I went to go see a personal trainer a few months ago, or actually maybe a year ago at this point. And this young kid, he's like, I'm going to make you work out so hard, Adam, you're going to throw up. I said, no, you're not. And I walked out and left. It's just not for me. Now, maybe a 20-year-old kid who's got super different goals, let's just put it that way and I'll leave it there, wants to go do that. And I'm sure there's nothing wrong with this kid's program. If he does go and I go through it and I throw up a few times, I'll come out stronger on the other side of that, sure. But I know myself, I'm not going to do that, period. So I'm not even going to enter the trade. My mind's every decision is a trade, because I'm not going to follow through. It's not going to work for me. So somebody who's a Warren Buffett kind of buy and hold investor and never sells it and so on and so forth, that's not for me either, because risk, what am I going to do? Buy something like go down 50, 60, 70, 80% and say, oh yeah, now it's undervalued? There's no exit strategy for me that I understand in that kind of world. So, okay, that doesn't work for me either. So find something that works for you. That's the beauty of the business, the beauty of life. There is no 1 + 1 = 2 magic formula for people to be quote unquote successful. It's find your bliss, find your happiness, find your joy. Find an approach in the market that works for you. And what I recommend people do is to create a plan. And I've got a whole coaching service where I help people and all that fun stuff. But really create a plan, because then you do what Ben Franklin taught us to do way back when. Is you're preparing and you do what Darvis did way back when, 50 years ago instead of hundreds of years ago. But again, you're doing the work before the market opens. And you're outlining a plan that allows you to win and that incorporates risk. And it allows you to find leaders, find breakouts, find setups, find stocks that are getting ready to break out that haven't broke out yet. Those are the setups. And say, okay, if this stock, I like it a lot, it's got good fundamentals, it's got good technicals, the pattern's tight, volume's drying up, looks good on a weekly chart, whatever the case may be, daily chart, whatever works for you. You like the earnings, you like the yield, you like the growth, whatever story works for you. But you like it, you want to buy it. All right, let's say it's trading between 100 and 95 for 6 months. Resistance would be 100, think of it like a ceiling in a room, and the floor would be 95 in that example. And all of a sudden, one day it blasts off above 100 on very heavy volume, 2 times normal volume. Well, who's buying? It's not Aunt Mary and Uncle Bob, like Gary says, which I love. It's the big institutions. And that's what you want to see. In order for that stock to go to 200 or 300 or 500, it has to get above 100 first. And that, folks, is the concept of a breakout. And why breakouts are so powerful. That's what Darvis did. He had these Darvis boxes, which are flat bases or rectangle bases, where basically he would just draw a line and say, oh, this stock's trading between 95 and 100. If it gets above, or whatever it is, 190, whatever, 55 and 60, whatever the numbers are. But you can just see patterns. And say, okay, if it gets above 100, I'm going to buy it. And if it goes down to 95, I'm going to sell it. And that's a 5% risk from entry to exit, not of your portfolio. Notice it's 5% from entry to exit. So how much of your portfolio do you lose when you're wrong depends on how you sized your position. Is it a 10% position? Is it a 20% position? Are you going all in? Which I don't ever recommend people do, but whatever you need to do for you, it all depends on the sizing. But the impact on your portfolio is super, super, super important. I can't emphasize that enough. So there's one thing, which is a level of risk from your entry to your exit. But then the second level of risk, which is the really important thing, is what happens to your portfolio if you're stopped out and you're wrong. That is so important. When I first started, I said, all right, I like the concept of sell 7 or 8% below your entry, and that's it. So I put entire account in there, and I lose 7% of it on one trade, or 8%. I did that 3 times. I was down 20%. I said, oh my Lord, this can't continue. But I didn't realize it's not a good idea to put all your money into one stock or whatever the case was, and then lose 7 or 8% of your entire account on one idea. Now oh my goodness. I mean, maximum is 1%, half of a percent, or 20 basis points, or 70 basis points, somewhere in that range. Maximum 1%. So at least that's what works for me. But everyone's free to do whatever works for them. So, hope that helps. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge.
You're listening to...
What are we waiting for? Well, what are you waiting for?
1, 2, ready, go.
Action!
Investor's Edge with Gary Kaltbaum.
And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. In case you're just joining us or missed any part of the show, you can go to GaryK.com, pause, rewind, fast forward, listen live, or archive, or around 24/7, anytime you want. All right, covered a lot of ground today. I love these timeless lessons. It's what drives me, propels me. So, we left off talking about creating a plan before the market opens every week. Why? Because it's very helpful to help you create some structure. So think about this. There's 2 people. One person has a discipline, structure. Let's say they're trying to become a better tennis player or golfer. They hit the ball, they show up in the morning, they go to do their practice, they work out, they eat well, they have a plan, they have a coach, they work really hard at it, they're focused at it, and they do it 6 out of 7 days a week. The other person dabbles. No real plan, wishy-washy, shows up on Monday, doesn't show up again for 6 months, puts the racket down, buys all the gear, by the way, at the beginning, gets really excited, buys all the gear, and then puts it down, collects dust in his driveway or in his garage or her garage, and that's it. Who's going to come out better in 6 to 12 months? The person with the plan and has structure, or the person without a plan? With the plan. Same thing in the market. It's amazing to me, the market, the way this works, because just about anybody can enter. All you need is not even $100 these days. They do accounts for free, I think. But in my day, it was $100, $200, $500, something like that. You open up a brokerage account online on an app. Now they do it. Take a picture, fill out some forms, your license, driver's license, whatever they're doing. Bum, bum, bum. Do some paperwork. You're done. You get an account. You can start trading stocks. Period. Like that simple. Become a doctor, you need 8 years of school or more. Become a lawyer, you're going to go to undergrad, then you're going to go to law school. Chiropractor, same thing. Dentist, same thing. stock trader or investor, hey, you got some money? Want to dance? So the barrier to entry is even to open up a store. You want to open up a dry cleaner, sell men's suits. You want to open up a messenger service. You want to open up, I don't know, the delivery company or whatever. It doesn't matter. Fishing companies teach people, sell fishing bait, worms. It literally doesn't matter. You need to have some element of conceptual knowledge or money to pay for the rent, to buy the supplies, buy the inventory, so on and so forth. Something more than $100 in most cases for most businesses, not all businesses, but for most of the time. You can sign a lease, you're going to get a property, you're going to get some blah, 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 blah. Okay, great. In trading, investing, you open up $100 and bam, you're a stock trader. And then people they wonder why they're not successful. But do you do the work? Do you want to do the work? There's going to be work here to get involved, to be successful, to be very successful, to beat the market. Everyone says, I want to beat the market. I want to beat the market. I want to beat the market. Great. So does everybody else. But it's a very competitive arena. You're competing against, you don't see your competition, but you're competing against some of the smartest, wealthiest, most resourceful people in the world. And the beauty here is that you can win. And so can I. It's based on our intellect, not some other outside external factor. Like basketball. There's no way I can play against Michael Jordan and win. I'm short. On a good day, I'm 5'6". Jordan, I don't know, 6'5". Shaquille O'Neal, 7 feet. I have no idea. I'm physically no way I can play against these guys and win in basketball. In the market, it's a level playing field. By the way, that's one of the reasons it attracted me to the market way back when in the 90s. I said, hold on a second here. Wait a minute. There's no physical requirements here? I don't need to have $1 million or $100 million to do it, or even $100,000 to do it. I had no money when I got started, so I was like, in real estate, it was either, I looked at around, I was like, where do the wealthiest people put their money? In stocks or in real estate? So I was okay, great. Real estate, I needed money to buy real estate. I didn't have any money, so okay, go to stocks. And that's literally how the decision-making process went. And then I had some success, but then I had a lot of failures, lost it all, and then some, and then came back, and then boom, 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 boom. In my first week of trading, quote unquote, my friend was trading for me. We grew up together, and he was a broker, and I wasn't. I was nothing to do with anything. And the account pretty much doubled the first day, more or less, was up 80%. And then the next day lost all the profits. Day 3, which was Wednesday, account opened on Monday. Day 3, Wednesday, the account's bankrupt, zero. We had to put more money in. I didn't have any more money. Went to the credit card, borrowed some money. Great. Thursday, the account doubles. And then Friday, we're bankrupt again. That's literally the first week of quote-unquote real trading I did. I bought some stocks earlier and stuff, but where I put real money into it. I'm real meaning real to me, and it was all relative at the time. It was all my money. At the end of that week, I'm like, whoa. I'm hooked. I got to figure this out. I just lost. Not just I lost, I got smashed. And now I'm in debt? Holy moly. I got to figure this out. So I knew I didn't know. And I had one skill. I had one job, not even skill. I had to learn. All I did in my life until today, that's why I get these timeless lessons. It's just, I know I don't know. Like Aristotle said way back when in Socrates, they had a great line. You don't know. Now you can learn. Okay, now I got to learn. So I started reading. And that was it. I just started reading and then doing and applying and reading and applying more mistakes and more mistakes. I fired my broker. We're still friends till today. I just spoke to him earlier today, actually. And great guy. But I, quote unquote, I decided to figure, I took control, took responsibility, and decided I'm going to figure this out on my own. Came up with a plan, structure, made every mistake under the sun, learned from those mistakes, post-analysis, study my mistakes. And then I had some level of success, a lot of success. I said, okay, great. I've got to a certain point where, thank you, Lord, I'm able to help other people and share my thoughts about the market and so on and so forth. And that's it. And that's what I do every day. And people like it, great. They don't like it, great. I'm happy to share what I can, help other people, because I know how it feels on a visceral level not to know and to want to know, want to figure it out. Structure. However you want to create structure, folks, strongly recommended. And if you want to email me your stories, feel free. info@findleadingstocks.com. That when you have structure on how you can get ahead, how you can get an edge, how you can plan for what's coming. Now, will you be able to catch every leading stock? No. I had somebody email me from Tuesday's show, said, Adam, that was really helpful. You're very welcome. You can't catch all the stocks in the market, and that's okay. Even if you have a plan, you're still going to miss some stocks. But that's okay. Because over a long enough period of time, hopefully you'll catch a few really good winners, and they'll more than make up for the small losers that you have. And if you manage risk properly, you'll do very well over the long term. And that's all the time we have for today. Thank you, everybody, for listening. Gary will be back. This is the one and only Investor's Edge.
This has been Investor's Edge with Gary Kaltbaum on BizTalk. To listen to past episodes or to get in contact with Gary, go to GaryK.com. That's GaryK.com.